Hello, good morning.
Yeah.
Yeah, good. Okay, good morning. Thank you very much. Yes, so we are welcome to another. So please let us inform others that the class has commenced because I can always see new people. So so we are going to round up with our last topic that we were treating in our last class, which is the withholding tax. I think we only, which of the questions did we solve? Which of the question have we solved on the withholding tax?
And we've not solved any question.
I think we have solved the number one question. Didn't we solve the number one question? We have not, Abby?
No, we haven't.
Okay. Yeah, okay. All right. So we are going to start from there now. So we are going to start from the question aspect, which is what? So I believe, so the regulation, we have as well mentioned about everything to the regulation last week. We should talk about the various things we need to know about withholding tax. And I will recollect I told us that it's not another form of tax. It's just what an advance payment of tax that is what deducted as source from payments you are making or receiving from a third party, which is going to be available as a set-off against your subsequent tax liability. By the time you now want to pay your tax, you are going to use it to set up your tax liability. So that is what the withholding tax is all about. So we also made mention of various aspects. I told us about the regulation and some other aspects relating to what the withholding tax, which we did the note aspect as far as the withholding tax is. So we are going to move straight away to the question today. So we are starting with the question number one, which is on page 8. Question number one, page 8. So the first question, so we are going to be the one to what to answer to solve this one by ourselves. So I will just be asking us because these are what I have already explained in our subsequent class. So in our previous class, sorry, I have explained them. So it's just what for us to have a better understanding. So the question number one goes thus: the administration of withholding tax is the responsibility of the appropriate relevant tax authority. State the relevant tax authority responsible for the administration of the following: one, company; two, firm, resident or Federal Capital Territory; professionals; individual; Nigerian ambassador in Beijing, China; UK ambassador in Nigeria. So I want us now to respond to this question. So while I call them one after the other. So who is the tax authority responsible for the administration of companies? Who can tell us under withholding tax? Which is the relevant tax authority for companies for withholding tax? We have done this thing last week now. Oh yeah, I'm listening to us. Yes, FIRS, thank you very much. It's FIRS, Federal Inland Revenue Service. Then the second one, we have firms. I hope, I I believe we should look for somewhere to be writing out the solution so that we can. Then the second one, firms. So who will be responsible for the administration of withholding tax collected from firms? Oh yeah, I'm listening. Firms. Firms. Hello, oh yeah now. Firms. Withholding tax collected from firms. So what the first thing is you need to look at what do they mean by these firms? Firms are a group of what? Group of companies in the same industry. So let me assist us. Firms are a group of companies operating in the same industry. So with that information I just gave us now, who will now be the relevant tax authority? Can tell us? Which tax authority do you think will be
FIRS.
responsible?
Federal. Federal Land
FIRS is
FIRS.
federal. FIRS, yes. Then number 3, resident of Federal Capital Territory, Abuja. Resident of
FIRS.
No. Resident of FCT Abuja.
FIRS.
No, that is wrong.
FIRS.
It's wrong. It's not FIRS. I made mention of something FCT IRS under the FIRS. So for resident of FCT Abuja, the withholding tax is payable to what? FCT IRS, Federal Capital Territory Internal Revenue Service. Then professionals, the number 4, professionals. Who will be responsible for the withholding tax collected from professionals? Oh yeah, now.
State Board Internal Revenue.
Yeah, State Internal Revenue Service of residents of the individual, because professional are usually firms of either partnership, enterprise, or individual. Then we have what? Individual. Individual.
The state.
State what?
State Board.
State
State
Internal Revenue.
State Internal Revenue
State Board
Service,
Internal
yes. Yeah, we have what? Nigeria ambassador in Beijing, China. Nigeria ambassador in Beijing, China. Who will be responsible for collecting that? Nigeria ambassador in Beijing, China.
FIRS.
FIRS. Yeah, do you all agree it's FIRS? Why?
Nigeria.
Why do you say it's FIRS?
They are non-residents.
Are you sure? This person is not a Nigerian ambassador in Beijing, China. It's not a non-resident. Truly, it's FIRS, but that your description is not the
It's not
answer.
in
This
Nigeria
person,
now. It's in China.
yes, the fact that it's in China is what? Ambassador representing Nigeria in China. So it's our citizen that is representing us in China. So you see what? A resident, he's just representing us in China. So it starts, no, they call them members of what? Members of the foreign affairs staff. So they are members of the foreign affairs. So it's FIRA. Then UK ambassador in Nigeria. UK ambassador in Nigeria. Where his tax going to be remitted to?
FIRS.
UK. FIRS, are you sure? UK ambassador in Nigeria. So this person now is not a resident of Nigeria. He's not a resident, so he's not going to be liable to tax in Nigeria. He just came to Nigeria to what? To come and represent his country. The same way that person that went to China went there to come and represent us in China. So this UK ambassador in Nigeria is going to be liable to tax in his what? In UK what? UK country. So he's not going to pay tax here in Nigeria because he came to represent his country here in Nigeria for the purpose of what? For the purpose of to foster trade and what? And cordial relationship between Nigeria and what? And UK. He's not going to be liable to tax in Nigeria. So please, you may be asked for the one relevant tax authority of the various taxpayers. So please let us also look at the material and get what the relevant tax authority. So that is for that. So we now move to the second one, which is the computation part. So question number 2. We just started Nigeria Limited has been trading for many years, making up its account to 31st May annually. The financial result for the year ended 31st May 2020 and 2021 as adjusted for tax were as follows. Year ended 31st May 2020 and 2021. We have the figure: trading profit, bank interest received net, gross debenture interest received, the dividend received from Grace Love net, dividend paid to shareholder gross. All are the information provided. They now said you are required to determine the net withholding tax payable or receivable but we just started Nigeria Limited, arising from his activity paid and received by it. Compute the company income tax liability for the relevant year of assessment. Ignore capital allowance. Note, assume tax rate equals to 20%. So those are the information the examiner expects us to do. Based on our practice, so we are going to state it in form of an Excel to make it easier for us. So we are going to make use of an Excel to solve the question. So let me upload an Excel sheet so that we can use that to tackle the question. So the first thing, the question asks us for what? And we know that we have two types of withholding tax. Who can remind us of the two types? Can somebody remind us the two types of withholding tax that we have?
Receivable and payable.
Yes, receivable and payable. Thank you. We have the withholding tax receivable and the withholding tax payable. So those are the two categories of withholding tax that are available: withholding tax receivable and withholding tax payable. So those are the two categories of withholding tax that we have available. So let me now. So as we have stated, so let me expand the font of the so that it will be visible as somebody complains. Let me expand the yes. So we have what? So the first thing we have the A part. A part. We just started. The name of the company. We just started Nigeria Limited. So we are asked to what? Computation of withholding tax payable and receivable for relevant year of assessment. For withholding tax is payable on what basis? Who can remind us? Actual or preceding? What basis is withholding tax payable?
Actual.
Yeah, actual year basis. Withholding tax is on actual year basis. So we have withholding tax payable. And so let us look at the information one after the other. We are giving trading profit. The profit you generated from your trading activity, is that liable to withholding tax? Is it part of the transaction that we listed for withholding tax? Is it part of the transaction? Trading profit?
No,
Is it part of those? No, it's not part of the transaction. So if we look at those transactions that we have under our year, from page 2 to 3, you can see that trading profit is not part of the transaction. That's the profit from their normal activity. It's not part of. So that no withholding tax on that. That will attract to the company income tax. Then we have a bank interest received. So please, before I analyze this, so let me illustrate something for us here first. Information can be given to us in three forms. It's either the examiner can say interest. The examiner can say gross. Let me analyze it for us. The examiner can say gross. The examiner can also say interest. The examiner can also say net. Then the examiner can say interest. And the examiner will be silent. Please, where the examiner say interest gross, whatever the, I'm just using interest as well as an example. Whatever the form of income or transaction that you are giving, once you see gross in front, what that means is that what the total amount is given to you. Both the amount of the transaction and the withholding tax. Everything is given to you. That means that transaction has not suffered any withholding tax. You are giving the full amount. That is why what that gross means. So then, why if you are giving interest, if they say interest net, what that means is that what the person paying you that interest has deducted the withholding tax. That means what the amount you have is what minus the withholding tax. You are having what the amount minus the withholding tax. Take note of that. The way the examiner just say interest without saying whether gross or net, please. What that means that what? You assume what it is what? Gross. Please let us do it. You need to have knowledge. So take note of what? Those three information I just mentioned. So that after that, so let us now go to the question. The question we have was after trading, we have a bank interest received net. You can see the examiner says net bank interest received.
I'm sorry, sir. What did you say about the third one? The one that has only interest.
Okay, where they say interest, you assume it is all gross. Assume gross. You assume it is gross.
Okay, sir.
Yeah. So the examiners, we are giving gross debenture interest received. Gross debenture, okay, sorry, bank interest received net. So that means what? This is the income received from where? From another place. This company is receiving that income from another place. And before they receive that income, that person paying them as well as deducted withholding tax. That's why you have net in front. So I now want to ask you, what category of withholding tax is this information going to give rise to? Who can tell us what category of withholding tax? What can bank interest receive? What category of withholding tax is it going to give rise to? Is it payable or receive or recover or receivable? Oh yeah, I'm listening to us. What category of withholding tax is this transaction going to give rise to? Is it withholding tax payable or receivable?
Receivable.
Yes, thank you.
Receivable.
Receivable. Because you are what? You are receiving payment from where? You have suffered that amount of withholding tax. So because you have suffered that amount of withholding tax, you are going to what? It's going to be, you are going to claim it. So you have what? So we have what? The first category of withholding tax we are going to calculate on is withholding tax with receivable. We have the year. We have the year to be. So let me now share my Excel. So I have my withholding tax receivable, which is in which the year we have the 2 years. We have 2020 and 2021. I want to list out the year. I have 2020 and 2021. 2021. All this information I want to put, okay, no need. So I want, so bank interest, so I have bank interest received. We are giving information, so we are giving 2020 and 2021. So we are giving bank interest received. In that information given of 2020, we have 720,000, 2021, 1,080,000. So the next thing for you is to look, first of all, look at what is the interest, what is the withholding tax rate on interest? What is the withholding tax rate on interest?
10%.
10%. Thank you. The withholding tax rate on interest is what? 10%. So instead, the implication of that is that instead of this person to receive 100% because we are giving net, that means this person receive what? 100 minus 10. This person receive what? 90%. That is the implication of that net. They receive 90%. So how do we now calculate the withholding tax? So we can now go to our workings. So let me now do my workings here. Workings, 1. So how to calculate it is either you gross up that value. In 2020, you calculate the gross value of that amount. What do we mean by this gross value? I said earlier that what? That amount is at 90%. It is either for 2020 year of assessment, it is either I gross that amount. Grossing it up, I want to make it to be what? 100%. I will say 100 over 90 multiplied by the value. How much is the value we have for 2020? 720,000. Multiplied by 720,000. That will give us how much? That should give me a value of 800,000. I need somebody to confirm this value for me. Is it correct? Does it give us that amount? It should give me 800,000. Is it correct? That should be 800,000 equals to 800,000. Is it correct? I need somebody to
Correct,
help me
it's correct,
confirm.
sir, it's correct.
Yeah, 800,000. It will give us 800,000. So this 800,000 now. So this 800,000 now is the gross amount. But what we receive is what? 720. How do we now? The withholding tax will simply be equals to 800,000 minus 720,000. So that will give us how much?
80,000.
800 minus 720. That will give me 80,000 naira. It will give us 80,000 naira. Or instead of doing that, instead of grossing it up, you can as well calculate the withholding tax straight away. You can say your withholding tax amount, since you know that withholding tax is 10%, will simply be 10 divided by, and you know that the value given to us is provided at what, 90%, divided by 90%, multiplied by 720,000. So that will give me this 80,000 that we calculated. So either way, you are going to get what? So the same 80,000. So that will be what? What we are going to use to what? To calculate what? The withholding tax for what? For the first scenario. Any question on that? Any question? So that is what, in the case of for the what, 2020. We also need to what? To calculate for 2021. In 2021, the same procedure. 2021, I know that for 2021, we are giving 1,080,000. So it's either you gross it up and say 100 over 90 multiplied by 1,080,000. How much do we have? 100 over 90 multiplied by 1,080,000. How much does that give us? Can somebody work it out?
88.
No, now. 100 over 9.
8888.
No, it's not possible. 100 over 90 multiplied by 1,080,000.
Okay, hold on, please.
It will give you
100
1.2.
over 90 times 1,080,000.
It will give you 1.2.
1.2, yes, sir.
It will give you 1.2. So if the value is 1.2, to get the gross is 1.2, to get the withholding tax will simply be 1.2 minus 1080. That should give us what? 120,000. Which is what? Which is this. So for this one, so that will give us what? 120,000. This is for year 2021. Or instead of doing that, you can do the same way we did this, which is what? How do we do it? Which is what? 10 over 90 multiplied by 1,080,000. Multiplied by 1,080,000. So that will give us 120,000. Either way, you give us what? This withholding tax value. So that is what? For the first category of transaction. After the first category, another transaction we have is gross debenture interest received. Look at that word, please. That word gross. Did they suffer any withholding tax before they collect this amount?
No, sir.
No, because it was, so that means what? No withholding tax was suffered on this income. That means what? They cannot claim what? Any withholding tax on this income. Do we get that? So they cannot claim any withholding tax on, because what? The money was collected in full. They collected the entire 100%. So no withholding tax will be claimed from this particular income. So do we get that? So that is so no withholding. Then the next one we have a dividend received from Grace Love net. What category of withholding tax will this one give rise to also?
Receivable.
Yes, withholding tax receivable. And don't forget, dividend is an example of which type of dividend is an example of which type of income? Who can remind us? Dividend is an example of
investment income.
Yes, thank you. Frank investment income. Dividend is an example of what frank investment income, in which any withhold, but notwithstanding, you are still going to calculate what the withholding tax on it. What that means is that what, please, for dividend, this is applicable to, what I want to say now is applicable to dividend only. For dividend, whatever form you are told, whether you are giving that dividend as gross, whether you are giving as net, or the examiner is silent, whatever form you are giving, withholding tax is always applicable on it. That is only applicable for dividend. Whether they tell you the dividend is given to you as gross, there must be withholding tax on it. Whether it's given to you as net, they would have paid deducted the withholding tax, or whether the examiner is silent. Please, this is only applicable to dividend. So dividend, we have a dividend received from Grace Law, net. So dividend received, so that will also give us, so we have what? The second item, which is what? Dividend received. Dividend received. For dividend received, so we go to our next working, which is what? Working 3. So we have a dividend received. So for dividend received in the first year, we have a 2020. So net, they receive 360,000. It's the same amount, 360,000. And what is the percentage of withholding tax on dividend? What is the percentage of withholding tax on dividend? You can tell me. Percentage of withholding tax on dividend.
10%.
It's also 10%. It's also 10%. That means what they receive what? 90%. So what that means is that what? That means what? You are going to calculate. So that will be what? It's either you also gross it up. Grossing it up, that will be what? 100 over 90 multiplied by 360,000. So that will give us how much? That should give me 100 over 90 multiplied by 360,000. That will give us how much? Oh yeah. Oh yeah, now let us place calculator. 400,000. That will give us 400,000. It will give us 400,000. 400,000. So to calculate the withholding tax, the withholding tax will simply be gross minus 400,000 minus 360,000. So that will give us how much? That will give us how much? 400 minus 360. Oh yeah, now you people.
40,000.
40,000. 40,000. That will give us 40,000. Or instead of that, you can as well calculate it straight away by saying 10 over 90 multiplied by what? Multiplied by 360,000. That will give us the what? The 40,000 withholding tax. Either way, it's applicable. Either way you want to what? You want to adopt is applicable by the examiner. So the withholding tax on this will be what? Will be 40,000. So you have the same amount for the 2 years. It will be what? Dividend received. We have 40,000. We also have here 40. Also have here 40,000. So after that, the next category of transaction we are told in the question is dividend paid to shareholder gross. Dividend paid to shareholder gross. So I want to ask, what category of withholding tax is this one going to give rise to? What category of withholding? Payable. Thank you. It's going to give rise to what? Withholding tax payable. And don't forget what I told you. Whatever form dividend is given to you, whether they give you as net, as gross, or the examiner is said, it will always what? Generate what? Withholding tax. Because what? It is what? Frank investment income. So that means what? We have what? Withholding tax. So the next one we have what? Withholding tax. Withholding tax payable. So we have what? Dividend paid. So we are told in the question, dividend paid. In the question, we are told, I'm going to share. We are told dividend paid 2020, 2,000 and 3,000. So let me share the screen now. 2,000 and 3,000. So dividend paid 2,000. So you can also do your workings to calculate the withholding tax. But yeah, when you are doing your workings, don't forget you are giving that amount as what? Gross. That means what? You have what? The entire what? 100%. Abi? Is that also? When they say gross, that means what? You have what? The entire 100%. So working for. So dividend paid. So to get the withholding tax, because you have the entire 100%, the withholding tax will simply be 10% multiplied by 2 million. 10% multiplied by 2 million. That should give us how much? 10% of 2 million. Oh yeah, now somebody
200,000.
200,000. The second one will be 10%. 10% multiplied by 3 million. That one will give us what? 300,000. So that means what? Withholding tax payable will be 200,000 and what? 300,000. 200,000 and 300,000. Then those are the what? That is the last. Apart from this, we don't have any other information again. That is the last information given to us. We now go to our solution again. So my question now is this. So my total withholding tax receivable will give me, total of this one, total of this will give me 80 plus 40. That will give us what? 120,000. Abi? Why this one will give us 160,000? Why this one will give us, total of this will give us 200,000? Why this one will give us 300,000? My question now is this. Can I remove this 120,000 from this 200,000? Can I remove it?
Yes, sir.
Are you sure?
Why not?
Are you sure? Can I remove this? So I told you last week, that's what. The withholding tax payable cannot be what? And receivable cannot be offset against one another. They have to be treated as separate items. Where at the end of the year, where you are here to what? Any withholding tax receivable, where you are here to claim it at the end of the year, you should state it as what? I mentioned it last week. You should state it as your current asset in your statement of what? Financial position. Where at the end of the year, you are here to pay it to the relevant tax authority, any withholding tax payable, you are going to state it as what? As current liability. So please, you cannot remove what? The withholding tax receivable from what? The withholding tax payable. So they are to be treated as what? Separate items. So please, let us take note of that. They are not what? They are individual separate items. So you cannot set them against one another. So let us take note of that. So that is for that. After that, so the second, that is for the first part of the question, so which we have dealt with, determine the net withholding tax payable or receivable. We just started Nigeria Limited, as from the activity paid and received by it. We have done that. Then the B part, they now say compute the company income tax liability for the relevant year of assessment. Ignore capital allowance. So the tax liability will now be what? Will now be payable on what? Preceding year basis. So number B now. So if you now want to compute the tax liability, don't forget, very important, you also want to start with the name of the company. We just started, Nigeria Limited. Computation of tax liabilities for relevant year of assessment. The year of assessment now will now be what? Preceding year basis. Instead of 2020 and 2021, it will now be what? 2021 and 2022. So tax will be payable on what? On preceding year basis. But the withholding tax is payable on what? Actual year basis. So the tax now will now be payable on what? On their income. The first income they generate is what? Trading profit. We have 5,000 and 7,000. So we are going to pay tax on that. Trading profit, 5,000. Trading profit, 5,000. 5 million. So let me express them 5,000 and 7,000. All these are in thousands. So I want to work in thousands. So let us take note of that. They are in thousands. I'm working in thousands. After that, the next thing we have a bank interest received net. Bank interest received net. When they gave us this information, we are being given net. But the income of this taxpayer is gross income. Income of this taxpayer is gross income. So that means when you are going to state his income, you state what? His total income, his total gross income. You are going to state his total gross income, bank interest received. So you now come here, you now come to our solution. Bank interest is also an income received. So you are going to state the gross amount. Don't forget, when we are doing the calculation, we have calculated the gross amount here. For the 2020 gross amount happened to be what? 800,000. Why for this one, the gross amount happened to be 1.2? Yeah. On this one, these are the gross amounts, 800 that we calculated here and 1.2. So that amount is what we are going to put here. 800, 1.2. So after that, you also look for another income. Another income generated by this company is what? Gross debenture interest received. This one is given to us in gross already. So you state it for 400,000. Debenture interest received. Gross. 400. So after that, another income we have is what? We have dividend received from Grace Love. Net, we're also going to state the gross amount. Dividend received from Grace Love. Dividend received. Gross. The gross amount, we calculated it to be what? To be 400,000 here. We calculated it to be 400,000 here for the dividend. So we calculated it to be 400,000. So we have it as well, 400,000. The next transaction we have is what? We have what? After that, the next transaction we have is what? Dividend paid to shareholder. Is this one an income? Dividend paid to shareholders. Is it an income? No. Dividend paid to is not an income. It's a payment. So it's not going to be liable to tax. So the only tax they are going to pay on it is withholding tax, but that will be suffered by the shareholder. So it's not an income. So they are not going. The company. So that is what part of their. So those are the income. You now add up these to get what? This will give you what? Total income. Total income. We have the addition of all this to get our total income. Addition of this will give us a total income. Oh yeah, somebody should help me add up all this from 5,000 to this amount.
6,600.
6,600. What about the second one?
9,600.
9,000.
9,000.
8,600.
9,600. Out of this income, we have an income that is called frank investment, FII. Which income is frank investment out of this income?
That one is 9,000 now. It's not 96.
9,000 now. I said 9,000.
Okay, it's 9,000. Somebody said 96 now. Part of this income, total income, all this income that we stated here, one of them is frank investment income. Which of it is frank investment income? Who can tell us? Which
Dividend
of this income? Yeah, thank you. Dividend received. Dividend received. This dividend received is a frank investment income. The dividend received is a frank investment income. So because the dividend received is a frank investment, and any income that is frank investment, Any tax you pay on it, you are going to, so it has to be eliminated. So we now remove, but you must first of all state it as part of the income. How much is the dividend? 400. So you are going to say minus 400. Again, here minus 400. Minus 400. So that will now give us what? That will give us their taxable income, which is how much is their taxable income? This will give us 6,200. Abi? Why this one will give us what? 8,600. Which is what? They are what? They are so which is what? Which is their taxable income? Which is this taxable income now that this company will be liable to tax on a normal day. But because the question has said what? Assume tax rate to be what? 20%. So because of that, we are going to make use of what? 20%. CIT, so company income tax at what? At 20%. So we are going to calculate 20% of this 6,200 will give us how much? 20% of 6,200. How much?
1,240.
1,240. Then 20% of 8,600.
1,720.
1,720. This is the tax they are supposed to pay. But from this amount, they have already paid tax in advance. Less withholding tax suffered in advance. They have suffered withholding tax. Less withholding. They have suffered withholding tax in advance on what? On this particular what? On when you calculate on this what? Bank interest receipt of 80,000 and what? 120,000. We cannot make use of the one for dividend. Why? Because what dividend has been what? Eliminated from this income. Because dividend is frank investment income. So the withholding tax they suffered on this particular income of what? Bank interest will now be what? Will now be used as a claim. From where? From bank interest. So which is what? You now say minus 80 minus 120. So the resulting figure will now be one final tax liability. So instead of this company to pay 1,240,000, they're going to pay 1,240,000 minus 80,000 that they have paid in advance. That will give us how much? Oh yeah. Hello. 1,240 minus 80. Are we tired?
1160.
1160. 1,720 minus 120.
1,600.
1,600. So what that means is that instead of this company, by the time they now want to, this company now want to pay their tax liability, instead of them to pay 1,240,000, they are going to pay 1,160,000 because what? Because they have already paid 80,000 in advance. In 2020, in year 2022 year, instead of them to pay 1,720,000, they are going to pay 1.6 million because they have already paid what 120 in advance. So that is what withholding tax is all about. It's what an advance payment of tax. So any question on that? It's an advance payment of tax. So I'm going to share this solution with us later after the class. So let me save it so that I'll be able to. So you can see. So we have the solution here. So these are what we did there is what we also have here. So that is what we have here. So what we did is what we have here. Which is what we have here in our solution here. So which is what we have here. So please let us take note of that. So that is the solution for that. So any question? Then we are also going to look at another. Yeah, okay. I'm with you.
Okay. So in the question, they stated that that to apply a tax rate of 20%. So what
Yeah.
if it's not stated? Are we going to use the rule of if the company earns
Yeah.
million naira to
Yes.
25 million
Yeah. Yeah.
naira? Okay, all right, sir.
Yes. Yeah.
Okay.
So looking at it in this situation now, you are not in this particular question. If you look at this question now, assuming they did not tell us apply 20%, they did not give us information about what? About the turnover of the company. We are going to assume that this company is a large company. We are going to adopt to 30%. But where they give us information about the turnover, you are going to look at whether the company is what? Medium, small, or large. So, but if they did not give us this 20%, the percentage we are going to adopt here will be what? 30%. Why? Because of we don't have information about the turnover. So as a result of that, we are going to assume what? Assume large company. Any other question?
Yes, sir. But I thought the company's profit, since it's lesser than 25 million, we are going to use
Okay.
the
Hello.
20%.
Categorization. Hello. Categorization is not as a result of profit. Categorization of company is by turnover. Turnover is not the same thing with profit. What is turnover? If they say turnover, what is turnover?
Revenue.
Yes, total revenue, your gross. Why profit is what? What is profit?
Trade activity.
Eh? Profit is what? Oh yeah, now what is?
The revenue less allowable expenses.
Yes, profit is your revenue less expenses. So they did not. So we don't have information about revenue yet. So they gave us profit. So please don't confuse yourself. What you have here is what is profit, not revenue. So you cannot use that scenario here. Any other question? So in the absence of no question, we are going to look at another question, which is question number 4. Question number 4 on page. So we also have question number 4 on page 10. So question number 4 on page 10. So we have the question that the board of directors of Wahum Limited decided to issue 20 million ordinary share capital at 7 naira 70 kobo per share. XYZ Register Limited was appointed as the issuing house. Pat & Co was appointed as the accountant to the issue, and Bolaji Jinodi was appointed as the solicitor to the issue. The issuing house is entitled to 7.5% of the capital raised. The fee of the accountant and the solicitor to the issue was agreed at 4 million naira and 3 million naira.
Check your WhatsApp. Now only 3 by company.
Hello? Mute yourself,
No.
Oga. Who is
No,
that
now
person
only
now?
3 by 6.
Who is that person now? Lukman.
3 by 6. Why they follow me argue?
Lukman.
Now you can meet him.
Now only 3 by 6.
Let me mute him. Lukman. Mute yourself, oh. Okay, I've muted him. So you have what? So they now said the solicitor 3 and 4 million. SEC. This SEC is the Security and Exchange Commission. They are the regulator of what? Of issuing companies. Those that what? That issue shares. They are so one of their regulators is what? Security and Exchange Commission. It's entitled to 1% of the capital raise. Pat & Co. office is situated in Lagos, while Bola Jinodi is situated at FCT Abuja. Question A now says, compute the withholding tax payable and indicate the relevant tax authority. That is for the A part. Then B part, determine the total amount to be received by Wahum Limited from the issue. Then C, explain the position of the issue house in terms of the responsibility to the relevant tax authority. So those are the question. So this is a straightforward question. So how do we tackle this question now? If you look at this information, they are selling shares. And if you look at the transaction we listed, is shares part of the transaction we listed as part of the transaction that we attract withholding tax? Is shares part of the transaction? Shares, is it part of transaction that attract withholding tax?
No, sir.
Eh? What did you say? Oh yeah, no, I can't hear you now.
It is not.
Yes, it is not part of the transaction. You can see it's not part of the transaction. But why are we now talking of what? Withholding tax here? Because share, but for selling that share, they are going to receive commission. They are going to receive what? Professional fees. As a result of what? That transaction. There are some transactions that also come in, which is what commission that will be received by XYZ register. And what? The professional fee that will be received by the solicitor and what? And the accountant. All those are what? Are transactions that attract what? Withholding tax. They are transactions that we are going to charge what? Withholding tax on. So as a result of that, so we need to charge what? Withholding tax on what? On those what? On those transactions. So they now said, so the question A part, compute the withholding tax payable and indicate what? The relevant tax authorities. How do we what? How do we compute what? The withholding tax? So let me upload our normal sheet 2. Yeah. So A part is asking us for what? Computation. So the first thing, the name of the company is very important. So we have what? We have what? The name of the company, which is what? XYZ registrar. For me, wait, sorry. So we have what? XYZ registrar. We have XYZ registrar. So I want to, yeah, okay. So we have what? XYZ registrar limited. Computation, we have what? Computation of withholding tax payable for relevant year of assessment. Before we can compute this withholding tax, we need to do our working to get some information. Number one workings that we need to do is what? We need to get how much is the capital raised. Total amount raised. If you look at the question, let me go back to the question. In the question, we are told that they are going to issue an amount of what? 20 million ordinary share at what? 7.70 naira. So that means what they are going to raise will be what? 20 million. 20 million. 20 million times 7.70 naira. How much do we have? How much did that give us? 20 million times 7.70 naira. Oh yeah, now 20 million times 7.70 naira.
154 million.
154 million. 154 million. Out of this amount, we're told in the question that what? XYZ was appointed. XYZ will be entitled to 7.5% of the amount raised. So that means XYZ, commission to XYZ, commission now will be commission will now be 7.5%. So which is going to, so 7.5% of 154 million will give us what? 7.5% of 150. Oh yeah, now you people should press calculator now.
11,550,000.
11,550,000. I don't just want to be writing the solution. That's the reason why I want us to, so that what, you know where we got all those information by the time you are doing revision by yourself than me just working it here by myself and writing out the solution. Please let us quickly be what. So if we know that the commission is that, which is going to be collected by SYZ Limited, that is the commission. They also told us that what SEC is going to collect what percentage? 1% of the what of the amount raised. SEC will also collect 1%. So look at it. They said what? SEC is entitled to 1% of the amount raised. So we need to also get how much is SEC going to collect. So we also calculate SEC fee, security and exchange fee, which is what? 1% of the amount of 1% of 154 million will give us how much?
1,540,000.
1,540,000. So these are what is going to be collected by this category of what? Of taxpayers. So because this, so we are going to now calculate what the withholding tax. How do we now calculate? So I'm going to, because we have various recipients of this, of money from this transaction, I'm going to what? I'm going to put them in what? In tabular form. So we have what? We have the serial number, we have the recipient or the beneficiary. We can put beneficiary of that money. Who is the beneficiary of that particular amount? Then after the beneficiary, we have what the rate. What is the rate of the withholding tax? We have the rate. We have the amount of withholding, amount that the gross amount, which is what the gross. So let me put gross amount so that it will be easier for us. Gross amount. We have then after that we have the withholding tax amount. Then we have what? Withholding amounts. Then we have what? Relevant tax authority. So these are the information. So the first person that is going to receive money from this particular transaction will be what? SYZ registrar. SYZ register. SYZ registrar. What are they going to receive? They are going to receive commission, nature. I need to put nature of the transaction there also. Nature of the transaction is supposed to be there. So that's what we need to know. What is the, so nature of transaction. So what is the nature of the transaction that we enter into with SYZ? SYZ is going to receive what? Commission. Abi? So what is the commission? What is the rate of withholding tax rate for commission? Withholding tax rate for commission. So let us go back to our, let us go to our withholding tax rate. So let me share it back. So look at it. Let's go back to the, 5%. Are you sure? Okay, look at it. We have a commission, consultancy, technical management, professional fee. Rest company 5%. Company non-resident 10%. Individual resident 5%. Individual non-resident 10%. So this particular thing is what? So let us now go to this particular scenario. This particular activity, SYZ Register Limited, is it a company or an individual? SYZ Register Limited is a company. So the rate is supposed to be 5%. That means that solution is, so they use this, that solution is based on, it was based on what? On old rate. Please take note of that. It was based on the old rate. So it is company and resident company. So because we are not told that this company is non-resident, they even tell us XYZ Registrar Limited. So that means it's a Nigeria company. So we are not told that it's a non-resident company. So we assume it is a resident company. So the rate is 5%. How much is the commission they are going to receive? They are going to receive a commission of what? 11. So we have it here. We calculated it here to be how much? 11 million gross amount. 11,550,000. 11,550,000. And what is the withholding tax amount?
Your screen,
that will be what? Yeah?
It.
What did you say?
You
Okay.
are forgetting to share the Excel.
To share the Excel. Okay. Sorry. So the withholding tax commission rate, the commission amount is 11,550,000. So the withholding tax amount will simply be what? 5% of 11,550,000. That will give us how much? 5% of 11,550,000. That will give us how much?
577,500.
5?
77,500.
577,500. So who will now be the relevant tax authority for this transaction? Relevant tax authority, FIRS. Relevant tax authority will be FIRS. That is the first one. Then the second, this transaction will also give rise to what? Somebody, the accountant, will also collect money. What is the name of the accountant? We have what? Bola Jinodu. No, Pat and Co. Appointed the issue, Pat and Co. accountant. Bola Jinodu is the solicitor. We have what? Pat and Co. Which is what? The accountant. We have what? We also have what? Pat and Co. The accountant. We have Pat and Co. We have Pat and Co. Which is the accountant. Is going to collect what? Professional fee. Professional fee of how much?
10%.
Of how much? 4 million. 4 million. And what is the withholding tax rate for professional fee? So Pat and Co, is it an individual company or is it a company or individual? Is the taxpayer a company or individual?
In partnership.
Partnership, it is still what? 5%. So it is still 5%. They are going to collect 4 million. 4 million. 4 million. 1, 2, 3, 1, 2, 3. So withholding tax will be 5% of 4 million. That will give us how much? 5% of 4 million. Oh, yeah, press your calculator now.
400,000.
400,000. So the withholding tax will give us 400,000. So what will be the relevant tax authority? If you look at the question, we are told that the question stated something here that, look at it, the question stated that Pat and Co. office is situated in what? Lagos. So since the office is situated in Lagos, which tax authority will be the relevant tax authority?
LIS.
5% of 4 million is not 40.
Is
100.
what?
200,000.
200,000.
You guys gave me 400,000. No? 200,000. Then the third one, number 3. So number 3, we have a Bola Jinodu. Bola Jinodu, which is the solicitor. The solicitor will also collect what? Consultancy fee or solicitor fee or whatever you want to call it. Consultancy fee, which is also what? At the rate of 5%. Bola at how much? 3 million. So 5% of 3 million will give us how much?
150,000.
150,000. So 150,000. 150,000. In the question, we are told that Bola Jinodu is situated where? At where? It's situated at where?
Abuja.
FCT Abuja. So what will be the relevant tax authority for Bola Jinodu? What will be the relevant tax authority for Bola Jinodu?
FIRS, IRS.
FIRS, IRS, FIRS, IRS. Is it FIRS, IRS or
FCT IRS?
FCT? It's called FCT IRS, so not FIRS, IRS, please. Do you get that? It is called FCT IRS, not FIRS, FCT IRS. Please take note of that. FCT IRS. So that will be the tax authority with that work. What I did not do, relevant income will be what? Yeah, withholding tax will be paid to. So those are the what? Those are the withholding tax that is due on this transaction. So the B part is also asking us for a particular information, which the B part is saying we should what? We should get what? We should calculate, determine the total amount to be received by Wahum Limited from the issue. Who is Wahum? Wahum is what? Is the owner of that share. How much are they going to receive from this issue? So let us look at it. Total amount, Wahum Limited. Total amount received. Total amount received. So Wahum Limited, they are supposed to receive the total income that will be generated, the total money that will be raised from this is what? 154 million. Abi? Is that not so? Oh yeah, now 154 million. Total money raised. Total money raised is 154 million. Out of this 154 million, they are going to pay this person total money raised. Out of this total money raised, XYZ is going to collect commission. XYZ commission. How much is XYZ commission? 11,550,000. It's going to be collected from that money. The solicitor, the accountant, Pat & Co. Pat & Co. is also going to collect his own money. How much is Pat & Co. going to collect? 4 million. They are going to 4 million. Also, Bola Jinodu, the solicitor. Bola Jinodu, the solicitor, is also going to collect how much? 3 million. From this money, they are also going to pay SEC fee. SEC fee of how much? How much is it? We calculated SEC fee here to be 1% of the money rate, which is what? 1,540,000. So they are also going to pay SEC fee of what? 1,540,000. So when you remove all this money from the total money raised, when you remove all this, so we have what? We have less. You are going to less all these amounts. Less 1, 2, 3, 4. So when you less all those amounts from those money, so what you arrive at will be what? Will be money to be what? To be raised. So you have what? Amount to be collected now. Amount to be received. Amount to be received. How much do we have? Amount to be received. 133,910. So amount to be raised will give us 133,910. So amount to be raised will give us 133. Raised will give us 133,910. So that is what amount they are going to raise. That's what this part Wahum is going to collect from where? From this issue. Instead of collecting 154 million, they're going to collect 133,910 because there are some money that are also going to be deducted from that payment. So that is what? That is that. Then the last thing we are asked is what? We are also asked to what? To do to what? They ask us to what? The question, explain the position of the issuing house in terms of responsibility to the relevant tax authority. So please, what is the who can tell us, what do you think will be the position of the issuing house? Who can tell us what is the position of the issuing house as in terms of responsibility to the relevant tax authority? What is the position of the issuing house, which is SYZ registrar? What is their position? Oh yeah, I'm listening to
They
also.
act as an agent of collection.
Yeah, they are going to act as the agent for the collection of what? Of the withholding tax and remit it to the relevant tax authority accordingly. Why? Because they are the one that will receive all this money. They are the one that will receive this money on behalf of what? WAUM Limited. So before they now remit to WAUM, they must what? Remit all those money to the what? To the relevant tax authority. They will act as agent. You can see we act as agent to the what? Relevant tax authority for the collection of the authority from and remit accordingly. We're going to act as agent for the collection of what? Of the withholding tax. So let us take on. So any question? Any question? So we also have some other questions there. So I will implore us to look at those questions. You can treat question number 3 as our assignment. So you can do it as your assignment and send it to me. I'll help you look at it and tell you where you have any challenges. So if there so those are what? So those are what you are expected to know as far as what? As far as withholding tax is concerned. It's what an advance payment of. Any question? Any question? Any question? So in the absence of no question, so that has successfully make us to what? To complete on what? On withholding tax. So we have successfully what? Completed what? The information on withholding tax, the class of withholding tax. So before we go today, we are going to introduce ourselves to what? To the next topic we are going to be treating, which is what? Value added tax. So which is our next topic, which is what? So we are going to start with that. Continue from our next line of topic. So value added tax. So value added. So this one is different from where. So it's similar to withholding tax, but what? It's different. And you can have a transaction that will both be liable to both what? Withholding tax and what? Value added tax. Only that what? The people that will pay what? That will pay the taxes differs. Those that will pay the taxes will differ. So those that will pay the value added tax will be different from those that will pay what? The withholding tax. So value added tax. So value added tax, is just an increase in what? In the value of goods or services in the process of what? Of production or delivery. When you are increasing the value of what you are producing, that is, or you are adding more value to what? To the goods you want to sell, or you are adding more value to what? To the services you want to sell. Maybe by the time when the manufacturer, for instance, maybe you are somebody that is selling a soft drink. When the manufacturer produces the soft drink, the manufacturer did not ice those soft drinks. The manufacturer just produce it and make it available as in hot form. But by the time you, as the seller, you want to sell it, you refrigerated the soft drink and make it available to to the customer. That means you have added value to that particular item. So that value you added is what is going to be charged as the tax. And value added tax is a form of consumption tax that is levied at the various stages of production and distribution. So you are going to, as from manufacturer to the wholesaler, from the wholesaler to the retailer, and from the retailer to the final consumer, in which the final burden is borne by the final consumer. The final burden will be shifted to the final consumer. Unlike in the case of the case of withholding tax, in which what it is the person that suffered, that is receiving the income, that is going to suffer the withholding tax. But in the case of this one, the person paying the value-added tax is not the one that's going to suffer. The burden will be shifted to what? To the final consumer. It is a form of what? Indirect tax. It is another form of indirect tax, that is what? Charge on what? Goods and services whenever what? Value is added. It's a form of indirect tax. So let us take note of that. It's a form of indirect tax. And this tax is administered, is collected only by what? By the Federal Inland Revenue Service. Collectable by only what? The Federal Inland Revenue Service. Unlike the withholding tax, which is collected by both what? The Federal Inland Revenue and what? The various state internal revenue service. But the value-added tax, only the FRS is what? Administer and what? And collect what? The what? Withhold the value-added tax. After collecting, they now what? They now distribute to the various state of what? Of the federation. So it is a form of tax. Initially, what they usually charge is called what? The sales tax. But the difference between these value-added taxes and the sales tax, that the sales tax is only charged at what? At the final stage, then, when the sales tax was used. But as I told you, the value-added tax will be charged at what? The various stages of what? Production and what? And distribution. That's the difference between what? Between what? The value-added tax and the sales tax. So the value-added tax is what? Is a replacement of what? Of the old sales tax, which was what? Which was in existence what? In the olden days. And what? It is governed by what? By the Value-Added Tax Act V1 LFN 2004. Before now, the rate was at the rate of what? 5%. It has now been increased to what? To 7.5% from February 2020. In the new tax reform bill now, they are even contemplating on what? On increasing it again to what? To another what? To a higher percentage, which is what we are waiting for in the new tax reform. But presently now, the rate you are going to apply is still what? 7.5%, which is what? The applicable rate that is available for the collection of what? Of the value-added tax. So that is what? Value-added tax. So the Finance Act, before now, there are usually problems on what will constitute what goods and services that will be liable to value-added tax. Specifically, the Finance Act has defined what is regarded as goods and what is regarded as services. So what do we mean by definition of goods and services? Goods has now been defined as what? All form of tangible property, any form of tangible property that are movable or immovable. So that means what can be regarded as good can be something you can move and something that cannot be moved. It is not only when you can move that item that you can regard it as good. If you cannot move the item as well, it can also be regarded as well as goods that are movable and immovable, but does not include land and building, money, or security. That means when you are engaged in what? In buying and selling of what? Currency, transfer of currency, buying and selling of currency, that will not attract value-added tax. Or when you are engaged in what? In what? In payment of rent. So that is also what? Exempted from value-added tax. So why services is referred to as anything other than goods. Anything other than goods provided under a contract of employment. Anything other than goods or services provided under a contract of employment. So anything apart from goods will be regarded as services, or service you are providing that you are providing for your what? For your employer. Like when your employer is paying you your wages and salary now, that will not attract what? That will not attract value-added tax. It's going to attract what? Payee. So that is not regarded as a service. For you providing what? An activity for your employer, as services. So, or any intangible or incorporeal, any intangible like goodwill, copyright, patent, products, asset, or property over which a person has ownership or right, or from which he derives benefit and which can be transferable from one form to another. Services also include what? Include intangible assets, incorporeal assets that can be transferred from one person to another, excluding what? interest in land, building, money, or security. So those are what we constitute goods and services as far as the Value Added Tax Act is concerned. And all this, so the following are to be noted in respect of goods and services. In respect of goods, so the first one is that these goods shall be physically, for the act, goods and services shall be deemed to be supplied in Nigeria. For you to say a goods is supplied in Nigeria, so one of the conditions is that these goods shall be physically present in Nigeria at the time of supply. For goods, that goods must be present in Nigeria for it to be what? To be liable to VAT in Nigeria. Then the beneficial owner of the right in or over the goods is taxable person in Nigeria. That person that is going to benefit from that goods or services is a what? Is a taxable person or a registered person in Nigeria. Then why a service will be liable to tax in Nigeria, where that service is rendered in Nigeria by a person physically present in Nigeria at the time of providing the service. Then why that somebody is providing service to you from outside Nigeria, but you are present in Nigeria, that service will be what? Will be liable to what? Value added tax once you are present in Nigeria. Then the service are provided to a person in Nigeria, regardless of what? Whether the service are rendered within or outside Nigeria. Whether the person providing that service is in Nigeria or from outside Nigeria. Once you are going to enjoy that service, you are what? You are present in Nigeria, you are going to what? That service is going to be liable to what? Value added tax. So the provision now provide further that service performed in Nigeria to person in Nigeria is liable to VAT, irrespective of the resident status of the service provider, which I just explained earlier. Service provided to person while in Nigeria, regardless of the medium of delivery of service, is liable to VAT in Nigeria. Service rendered remotely, I thought this was online services, remotely by other virtual means to Nigerian residents or person that are liable to VAT. Any services rendered remotely to somebody that is in Nigeria will also be liable to VAT. Where a third party is contracted to provide a service on behalf of a non-resident, so its permanent establishment of fixed base within a service attract VAT. So you are a non-resident want to provide a service to somebody in Nigeria, but they now engage you, somebody that is what? A resident of Nigeria, to provide that service on their behalf. So that service will be liable to VAT in Nigeria. So basically, service rendered and consumed by a Nigerian resident while physically outside Nigeria is not liable to tax. So note that service, the fact that I'm a resident of Nigeria, where I am not present in Nigeria as at the time I'm enjoying that service will not be liable to value added tax. Why? Because I am not present physically in Nigeria. So the service will not be liable to value added tax. Then why in respect of incorporate or copyright or patent, the exploitation of the right is made by a person in Nigeria. So that is the owner of the right is in Nigeria. The right is registered the right belongs here in Nigeria. The incorporate relate to tangible or immovable assets located in Nigeria. All those assets are located in Nigeria. Then what do we mean by exported services? The service will be regarded as exported service under the following condition. The service must be provided by a Nigerian resident to a non-resident. Look at it. By a Nigerian resident to a non-resident. Exported is that you are in Nigeria, you want to provide something to what? To somebody outside Nigeria. So that service is regarded as exported services. A non-resident person to whom the service is provided must be outside Nigeria when the service is consumed. For you to be sent for that service to be regarded as exported, that person that will enjoy that service must be what? Outside Nigeria. Where that person is in Nigeria, it will not be regarded as exported service again. So those are the conditions to determine what will constitute goods and services. So let us take note of the condition. So what are the objectives that government decide to bring up this VAT? To increase government revenue. Government, they need more revenue to make tax system more transparent, to avoid cascading effects, to reduce tax evasion, to increase exports, to simplify tax collection, to check income tax evasion. All these are the objective. Then we also have the features there. So, but where I'm particular about is what? This principle of what? Of VAT. Specifically, VAT has we have what is called the origin principle and the. So, as the name implies, origin, what do you mean by this origin principle? What that means is that the value added tax will be charged on the goods where on that item where the goods is being, not necessarily where the goods is being consumed. Value added tax will be charged on that goods wherever the goods is being produced, where the goods is being consumed. Whether that goods is being consumed in that country or not, they are going to charge for value added tax on that good. Most of these advanced country, because of they are what? They are producing country, they produce. So they adopt what is called an origin principle, in which was any goods you want to take away from their country, they are going to also charge VAT on on those goods before you can take it away from their country. So why the second principle is what? Destination principle. Destination principle. This principle is the one that we adopt here in Nigeria. But because why? Because we are what? We are non-producing country. We don't produce. We only rely on what? On foreign products mostly. So what does this destination principle mean? That the value added tax will be what? Will be charged on what? On the country where that goods is being what? Is being consumed. It is only when the goods is being consumed in that one, in Nigeria, that what we are going to charge a value added tax on it. Where they produce a goods in Nigeria and that goods is going to be what? Taken away out of Nigeria, that goods is not going to attract what? Attract value added tax. Only goods that are consumed in Nigeria will be what? Will attract value added goods and services that are consumed in Nigeria will attract value added tax. Why? Because of what is called what? Destination principle. So that is what we adopt in Nigeria. So any question? Any question?
Yes.
Okay.
The part where you explain the goods.
Okay,
You
good.
said
Yes.
Building and land are not part of goods. Does it mean that?
Excluding building. Excluding. There is
Yes.
what they're excluding here.
Yes,
Yes.
excluding
Let me go
building.
back to it. Yes.
Yes.
Excluding building. Yeah.
Yes. Does it
And
mean?
does not include land and building, money or
Uh,
security. Yeah. Okay.
Does it mean now if you buy a property like a building, you will not
Yeah.
pay tax, VAT on it? Sorry.
Yes, that is what it means.
Because I've seen where somebody want to buy a property and they are now saying you pay VAT. I was like,
Before now, when was that?
oh, recent though, the person wanted to collect VAT again. I was like,
Before now, the tax law is ambiguous because the tax law does not distinguish that. But now the tax law has specifically excluded it, excluding any land building. So the tax law has excluded it. So you are not going to be charged any VAT. So when you are engaging what sense of security or money, you are selling money. So no VAT will be charged on it. That does not mean you are not going to pay some other form of tax. So there are still some, that when
capital gain and
capital gain, yes.
Yeah.
They're still going to be liable to all those.
Thank you.
Value added tax has been excluded. Yeah.
Thank you.
Any other question? Any other question? So those are the principle guiding the value added tax. So just know that what we adopt in Nigeria is what? Destination principle. That means any item that we produce in Nigeria and we are exporting that item. We are not going to item is and what that makes it not advantage. So by the time you get to work, because you are going to do goods and services that are exempted from VAT. So you'll be able to see what to see those scenario of what the value added tax. So which is what we have as far as that item is concerned. Then we have what after that. So the next thing we have what are the terms that are common that we need to familiarize ourselves with as far as this value added tax is concerned. One of them is what is called number one, VATable activity. VATable activity. What they mean by this VATable activity, they can also call it taxable activity. Those are activities that are liable to VAT. So the name that we are going to be using for the purpose of value added taxes, either we call it a VATable activity or taxable activity. Those are the goods and services that are liable to payment of VAT. So, and these goods and services can be they can include activity of the government, they can include activity of club, they can include activity of not for profit making organization, anybody that involve in supply of goods and services that are liable to VAT for a consideration will be liable to value added tax. So that's what they mean by VATable activity or taxable, or you can call it a taxable activity. After VATable or taxable activity, the next one we have is we have a taxable or VATable person. Taxable or VATable person. Taxable or VATable person. Taxable or VATable person. So those are the people that trade in in VATable goods and services. Taxable or VATable person are those that trade in in VATable goods and services for a consideration. Those that sell those items that are liable to VAT. So they call them taxable or VATable person. So they are the one that will now deduct the VAT from any transaction that attract VAT and remit it to the relevant tax authority. They will deduct those transactions liable to value added tax and remit to the relevant tax authority. Such people, they call them VATable or taxable person. So, and this person can be can be government agent, can be supplier, can be owners of business, can be companies, and so on, provided you trade in in VATable goods and services. And every VATable person is respected to register with with FIRS for the purpose of value added tax. So every VATable person is expected to register with FIRS for the purpose of value added tax deduction, and is also expected to remit that amount to FIRS. So there is a time limit for the remittance of that amount, which is it must also be remitted within 21 days. 21 days of of the following month. 21 days, within 21 days of the next month, you must remit what is due. All the VAT that you collected for the previous month to the relevant tax authority. Failure to do that, we attract penalty and interest. So then we also have the third one, which is a VATable period. VATable period is a period of 1 calendar month, which commence from the beginning of a month to the end of the month. So that means for VAT purpose, you are expected to account for VAT on a monthly basis. Take note of that. Account for VAT is on a monthly basis. So as a VAT agent, you are supposed to account for VAT from January 1 to 31st of January. So which you now remit. All the activity for January must be remitted on or before 21st of February 2020 of that particular year, which is the VATable period of 1 month. So any question? Any question? Any question? Any question? Oh yeah, now I'm listening to us. Are we not there? Hello, any question? What happened now? I can't hear anybody. Hello.
No, we can hear you. We are good.
Yes, any question? Okay, no question. Yes. So in the absence of no question, so this is where we are going to end the class today. So we are going to continue from the input VAT from the terminology from our next class. So which is from input VAT. So that's where we are going from the number 4 terminology, which is input VAT. So that's where we are going to continue from our next. So the Excel is on 2 sheets. So the first solution is on the first sheet, while the second one is on the second sheet. I'm going to share it after the class now, so that we can also use it for our own personal usage. So thank you and have a lovely day ahead. So all right, thank you.
Thank you very much.